Ever feel like you're watching a dance, the constant ebb and flow of the market, and wonder if you could learn the steps to capture some of that movement within a single day? Welcome to Wealth Circuit IQ. Today, we're decoding a trading style that's fast-paced, deeply strategic, and often misunderstood by beginners: day trading. If you're looking for a clear, professional, and no-nonsense introduction to what day trading really is, how it works, and what it demands, you've landed in the right place. This is your What is Day Trading as a Beginner 2025 full guide, and our goal is simple: to equip you with the foundational knowledge, mental framework, and tactical understanding to approach intraday trading with confidence and clarity. And if you value depth over hype, discipline over shortcuts, and data-driven insight over noise, then make sure to like this video, subscribe, and turn on the bell icon, because this is more than just a tutorial, it's the beginning of your smarter trading evolution.
What exactly is day trading? The core concept. All right, let's get down to brass tacks. What is day trading, really? In its simplest form, day trading is the practice of buying and selling financial instruments within the same trading day. Think of it like this: you might buy a stock in the morning and aim to sell it before the market closes that same afternoon. The key here is that within the same day part. Unlike long-term investors who might hold on to assets for years, or even swing traders who hold for days or weeks, a day trader typically closes out all their positions before the market closes for the day. Now, what kind of financial instruments are we talking about? Well, it could be stocks, as we just mentioned, but it could also include things like options, futures contracts, currencies in the forex market, and even cryptocurrencies. The underlying principle remains the same: in and out within the day. So, to recap, day trading is about trying to capitalize on short-term price movements. Small gains, repeated potentially throughout the day, can add up. We'll delve into why someone might choose to day trade in the next section. But for now, the core idea to remember is buy today, sell today, or vice versa for short selling. Why do people day trade? Motivations and realities. One of the primary allures of day trading is the potential for quick profits. The idea of making gains, even small ones, multiple times within a single day, can be very attractive, offering the possibility of seeing results more immediately compared to longer-term investing. Another significant draw is the sense of autonomy, the idea of being your own boss. Day trading can offer the flexibility to set your own hours within market hours and make your own trading decisions, which can be a powerful motivator for some. However, it's absolutely crucial to balance these potential allures with the realities of day trading. One of the most significant realities is the high risk involved. The same short-term volatility that offers potential for quick gains also presents a substantial risk of equally rapid losses, something beginners often underestimate. Furthermore, while you can set your own hours, successful day trading often demands a significant time commitment, requiring active monitoring of price movements and the execution of trades during market hours. Finally, success requires a high degree of discipline and a continuous commitment to learning, as emotional decisions can be costly, and understanding market dynamics takes time and effort. This brings us to a crucial point. Let's debunk the get-rich-quick myth often associated with day trading. It's vital to understand that a significant majority of day traders lose money. While it's difficult to pinpoint an exact percentage, studies and reports consistently indicate that the vast majority are unprofitable. Some sources even suggest that 80 to 95% of day traders end up in the red. Therefore, while significant profits are possible, they are far from guaranteed, especially for beginners. Day trading is a skill that needs to be developed, much like any other profession, requiring patience, education, and Most importantly, realistic expectations about the potential for losses. So while the allure of quick profits and independence is real, it's crucial to approach day trading with a clear understanding of the inherent and statistically significant risks, the time commitment involved, and the need for continuous learning and discipline. Essential terminology. Every beginner needs to know. Before we dive deeper into the mechanics of day trading, it's absolutely crucial to build a solid foundation of terminology. Think of it like learning the alphabet before you can read words, or understanding the rules of a game before you can play. Without grasping these essential terms, the concepts and strategies we discuss later will likely feel confusing and overwhelming. So let's take the time now to understand the language of trading. It will make your learning journey much smoother and more effective. To better understand these essential terminologies, we've categorized them into 5 key groups. Number 1. Assets. Assets are resources with economic value. In day trading, assets are tradable instruments like stocks, ETFs, options, futures, crypto, and forex, each offering short-term profit opportunities based on price movements. Stocks. A stock represents a share of ownership in a company. When you buy a stock, you become a partial owner, shareholder of that company, and may be entitled to a portion of its profits, dividends, and voting rights in some cases. ETFs, exchange-traded funds. ETFs are bundles of stocks or assets, e.g., SPY Trax, S&P 500. They are investment funds that trade like stocks on exchanges. They track assets, stocks, bonds, commodities, and offer diversification at lower costs than mutual funds. Options. Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an asset at a set price by a certain date. They are used for hedging or speculation. Futures. Futures are contracts to buy or sell an asset at a fixed price on a future date. They're used for hedging risks or speculating on price movements. Cryptocurrencies. Cryptocurrencies are digital currencies secured by cryptography. They operate on decentralized networks, like blockchain, and enable peer-to-peer transactions without banks. They are extremely volatile and traded 24/7. Forex pairs. Forex pairs represent the exchange rate between two currencies, like euro per US dollar. Traders speculate on price movements to profit from currency fluctuations. Number 2. Long versus short. Long. Buying an asset expecting its price to rise, profit from gains. Short equals selling borrowed assets expecting price to fall, profit from buying back cheaper. Number 3. Bid and ask, spread. Bid, the highest price buyers are willing to pay for an asset, your potential selling price. Ask, lowest price sellers will accept, your buying price. Spread, difference between the bid, buyer's price, and ask, seller's price. Lower spreads mean better liquidity. Number 4. Key metrics, market impact. Volume, volatility, leverage, and margin critically influence stock markets. Volume reflects trading activity, validating trend strength or weakness. Volatility quantifies price fluctuations, often spiking during periods of uncertainty. Leverage magnifies potential gains or losses through borrowed capital, like options or margin trading. While margin permits larger positions but introduces the risk of forced liquidations, margin calls, during declines. Collectively, these metrics shape liquidity, investor risk appetite, and overall market stability or instability. Volume, trading activity level. High volume confirms trends. Low volume suggests weak momentum. Volatility, price fluctuation intensity. High volatility equals higher risk reward, like during earnings, news. Leverage, using borrowed funds to trade, boosts gains but magnifies losses, like options futures. Margin, borrowing from brokers to buy stocks, can amplify returns but risks margin calls if prices fall. Number 5. Order types. Order types are instructions to buy, sell assets in markets. Market order. Buy, sell immediately at the best available current price. Fast execution but no price control. Limit order. Sets exact entry-exit price. Guarantees price but not execution. Stop loss. Automatically sells to limit losses if price moves against you. Take profit. Locks in profits by auto-selling at a target price. So, there you have it. A quick, high-level rundown of some of the most essential terms every new day trader needs to understand. These concepts are the building blocks of smart trading, and while we've kept things brief here to avoid overwhelming you or turning this video into a 2-hour video feature film, don't worry. We'll be diving deeper into each one in the next videos, breaking them down with real-world examples and actionable insights. If you found this overview helpful and you're serious about sharpening your trading skills, make sure to like this video, subscribe to the channel, and hit that bell icon so you never miss an update. We've got a full series coming that's tailored to help you trade smarter, not harder. Getting started. The practical steps. Ready to dive into the electrifying world of day trading? It's thrilling, yes, but without the right roadmap, from picking your broker to mastering your platform, you're heading straight for a financial dead end. So, how do you actually start? Choosing a broker. All right, so you're starting to understand the fundamentals. The next crucial step for any aspiring day trader is choosing a broker. Think of a broker as your gateway to the financial markets. They provide the platform and the means for you to buy and sell assets. Selecting the right broker is a foundational decision, and there are several key factors you'll want to consider. First and foremost is regulation. You want to ensure that the broker you choose is regulated by a reputable financial authority. This helps protect your funds and ensures the broker adheres to certain standards. Depending on where you are in the world, this could be organizations like the SEC in the United States, the FCA in the UK, or similar bodies in other countries. Trading with a regulated broker offers a level of security and accountability. Next, you need to carefully consider the fees. Brokerage fees can eat into your potential profits, especially with the high frequency of trading in day trading. Pay attention to things like commissions, which are charges per trade. Some brokers now offer zero commission trading, but be sure to understand their other fee structures. Also, if you're trading Forex or CFDs, look closely at the spreads, which, as we discussed, is the difference between the bid and ask price. Wider spreads can make it more challenging to profit from small price movements. Be sure to understand the full fee schedule, including any potential charges for account maintenance, data feeds, or withdrawals. Platform usability is another critical factor, especially for day trading where speed and efficiency are often paramount. You'll want a platform that is intuitive, reliable, and provides the tools you need, such as real-time charting, technical indicators, and easy order entry. Many brokers offer demo accounts, which allow you to try out their platform with virtual money. This is highly recommended before committing real capital. The available assets offered by a broker must also align with what you want to trade. If you're primarily interested in day trading stocks, ensure the broker offers a wide selection of stocks. If you plan to trade options or futures, confirm that these markets are accessible through their platform and that they offer the specific contracts you're interested in, like NQ, ES, gold, crude oil futures. Finally, don't underestimate the importance of customer support. Especially as a beginner, you may have questions or encounter issues. A broker with responsive and helpful customer support can make a significant difference. Check their support channels, phone, email, live chat, and consider their availability. There are various types of brokers available. Some are more geared towards experienced traders with advanced platforms and features, while others focus on simplicity and ease of use for beginners. Some specialize in certain asset classes like Forex or futures. It's important to research and choose a broker that best fits your individual needs and trading style as you begin your day trading journey. Opening and funding an account. Once you've researched and selected a broker that seems like a good fit, the next practical step is opening and funding your account. While the exact process can vary slightly from broker to broker, there are some common steps you can generally expect. The first part is typically the application process. This usually starts online through the broker's website. You'll need to provide personal information, such as your name, address, date of birth, and social security number, or equivalent identification number depending on your location. Brokers are legally required to verify your identity. You'll likely also be asked about your financial situation, investment experience, and risk tolerance. This information helps the broker ensure that the services they offer are suitable for you. Be honest and accurate in your responses. After submitting your application, you may need to provide documentation to verify your identity. This often includes uploading a copy of a government-issued ID, such as a driver's license or passport, and sometimes proof of address, like a utility bill. The broker will then review your application and documentation, which can take anywhere from a few hours to a few business days. Once your account is approved, the next step is funding it. Brokers typically offer various methods for depositing funds. Common options include electronic bank transfers, ACH in the US, wire transfers, and sometimes debit or credit card deposits, though these might have limitations. Each method can have different processing times and potential fees, so be sure to check with your chosen broker. You'll usually find clear instructions on how to deposit funds within your account dashboard on their website or trading platform. It's important to only deposit funds that you are prepared to potentially lose, especially when considering day trading due to its inherent risks. Start with an amount you feel comfortable with, and that aligns with the broker's minimum account requirements, if any. Once your funds have been successfully deposited and are reflected in your account balance, you're generally ready to begin trading. You'll then navigate the broker's trading platform to find the assets you want to trade and place your orders. So, in essence, the process involves applying, getting verified, and then transferring funds into your new brokerage account. Each broker will have its own specific procedures and platform, so be sure to follow their instructions carefully. Understanding trading platforms. Once your account is open and funded, you'll be interacting with your broker's trading platform. This is the software they provide that allows you to view market data, analyze charts, place trades, and monitor your account. While each platform can look a bit different, most share some core elements that are essential for day trading. Let's go over some of the basics you'll typically encounter. One of the most visually prominent features is usually charts. These display the price history of an asset over time. You'll see different types of charts: like line charts, bar charts, or candlestick charts. Candlestick charts, in particular, are very popular among traders as they provide more information, showing the open, high, low, and closing prices for a specific period. You'll often be able to customize these charts, change the time frames, from 1-minute charts for very short-term trading to daily charts for a broader view, and add technical indicators to help you analyze potential price movements. Another crucial component is the order entry panel. This is where you actually place your buy or sell orders. You'll typically be able to select the asset you want to trade, the type of order, like market, limit, or stop loss, which we discussed earlier, the quantity, how many shares or contracts you want to trade, and sometimes other conditions like time in force, how long the order should remain active. Understanding how to quickly and accurately enter orders is vital for day trading. Most platforms also feature a watch list, or sometimes called a quote board. This allows you to track the prices of the assets you are interested in. You can usually customize this list to include the symbols you're watching, along with real-time price updates and other relevant data like the bid, ask, and volume. Having a well-organized watch list helps you quickly see what's happening with your chosen assets. Finally, you'll always find a section displaying your account balance and other account-related information. This will show you how much capital you have available for trading, the value of your current positions, and any profits or losses you've incurred. Keeping an eye on your account balance is crucial for managing your risk and ensuring you have sufficient funds for your trading activities. Remember, the layout and specific features can vary between different brokers' platforms. Some might have more advanced tools and customization options than others. The best way to get comfortable with a specific platform is to explore it. Use a demo account if available, and take advantage of any tutorials or help resources provided by your broker. Familiarizing yourself with these basic elements, charts, order entry, watch list, and account balance, will give you a solid starting point for navigating almost any trading platform. Basic day trading strategies for beginners. Now that you have a grasp of the essential terminology and the basics of a trading platform, let's touch upon some fundamental ideas about how day traders might look to find potential trading opportunities. It's important to understand that there are countless trading strategies, and becoming proficient in any of them takes time, practice, and further learning. What we'll cover here are just a couple of simple, conceptual approaches to give you a starting point. If we were to delve into the vast world of trading strategies in detail right now, this video would become quite lengthy. Rest assured, we can explore more specific strategies in future videos if there's interest. One basic concept is following the trend. The idea here is that if an asset's price is generally moving in a particular direction, upward or downward during the day, there's a higher probability that it will continue in that direction for a while. Identifying a trend can involve looking at price charts and noticing a series of higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. A simple strategy could be to identify an established trend and then look for opportunities to enter a trade in the direction of that trend. For example, if you observe a stock price consistently making higher highs and higher lows in the morning, you might look for a small dip to buy, anticipating that the upward trend will resume. Keep in mind that trends don't last forever, and identifying them accurately can be challenging, especially for beginners. Another introductory concept is range trading. Some assets trade within a relatively defined high and low price for a period. These boundaries are known as the range's resistance, the high, and support, the low. A basic range trading strategy involves identifying these levels and then looking to buy near the support level, expecting the price to bounce back up towards the resistance, or to sell near the resistance level, anticipating the price to fall back down towards the support. For example, if a stock repeatedly bounces between $50 and $52 throughout the morning, a range trader might buy near $50 hoping to sell closer to $52, or sell near $52 hoping to buy back near $50. Identifying clear and reliable ranges is key to this strategy, and breakouts from these ranges can lead to losses if not managed properly. It's crucial to reiterate that these are very simplified overviews of just two basic approaches. Real-world application involves much more nuance, including confirming signals, managing risk, and understanding market context. These examples are purely to introduce the idea that day traders often operate based on some form of strategy or system. As you continue your learning journey, you'll discover many more sophisticated and specialized strategies. The absolute importance of risk management. Let's get one thing straight. Losing money in day trading isn't just a possibility, it's a reality for many, especially in the beginning. As we mentioned earlier, a large percentage of new traders experience losses, often because they focus more on chasing profits than protecting their capital. That's why risk management isn't optional. It's your survival kit in the fast-paced world of day trading. Think of it like the seat belt in a race car. It won't help you win the race, but it dramatically increases your chances of staying in the game. Position sizing. One of the first principles every new trader needs to grasp is position sizing. This refers to how much of your trading capital you risk on a single trade. A widely followed guideline is the 1% rule, which suggests you should never risk more than 1% of your total account balance on any one trade. So, if you're trading with a $10,000 account, that means risking no more than $100 per trade. This protects your account from being wiped out by just a few bad decisions. The size of your position should be calculated based on your entry point, stop-loss level, and risk tolerance, not gut feeling or hope. Stop-loss orders. Next up are stop-loss orders, one of the most critical tools in your risk management toolbox. A stop-loss is an automatic order that tells your broker to sell your position if the price moves against you to a certain level. Let's say you buy a stock at $50 and only want to risk $2 per share. Then you'd place your stop-loss at $48. If the price hits that level, the system will sell your position, minimizing your loss. It's not about being pessimistic, it's about being realistic. No one gets every trade right, so protecting yourself when you're wrong is key to staying in the game. Take profit orders. Just as you plan to cut losses, you should also plan when to lock in profits. That's where take-profit orders come into play. A take-profit order automatically sells your position once it hits a target price, allowing you to secure gains without letting emotions take over. For example, if you buy at $50 and want to exit at $55, you set a take-profit at $55. If the price reaches that level, your trade closes with a profit, no second-guessing involved. This helps you stay disciplined and avoid the all-too-common mistake of turning a winning trade into a loser by holding on too long. The bottom line? Your number one job as a beginner isn't to make as much money as possible. It's to stay in the game. The market will always present new opportunities. But if you blow up your account early on by ignoring risk, you won't be around to take advantage of them. Smart traders focus just as much, if not more, on protecting their downside as they do on chasing the upside. Essential tools and resources for day traders. Okay, let's discuss some essential tools and resources for day traders. To navigate the markets effectively, you'll want to familiarize yourself with some of the common tools that traders use. Charting software. First up is charting software. This is where you'll spend a significant amount of your time analyzing price action and identifying potential trading opportunities. Many brokers provide their own charting tools within their platforms, which can be perfectly adequate for beginners. However, there are also dedicated charting software providers that offer more advanced features and customization. Some popular examples you might hear about include TradingView and MetaTrader. These platforms allow you to view historical price data, use various chart types, like candlesticks, and apply a wide range of technical indicators to help with your analysis. Economic calendar. Another essential tool is an economic calendar. This is a resource that outlines upcoming economic news releases, such as inflation data, employment figures, and interest rate decisions. These events can often have a significant impact on market prices, so being aware of them can help you anticipate potential volatility and plan your trades accordingly. Many financial websites offer free economic calendars. News sources. Staying informed is also crucial, which is why news sources are important. Keeping up with financial news, company-specific announcements, if you're trading stocks, and global events can provide context for market movements. Reputable financial news outlets like Reuters, Bloomberg, and the Wall Street Journal can be valuable resources. Be discerning about your news sources and focus on credible information. Demo account. Perhaps the most invaluable resource for a beginner is a demo account. Many brokers offer these, and they allow you to trade with virtual money in a simulated market environment. I cannot emphasize enough how important it is to practice with a demo account before risking any real capital. This allows you to get comfortable with the trading platform, test out strategies, and understand how different order types work, all without the emotional and financial pressures of live trading. Treat your demo account seriously as a learning ground. Finally, if you're serious about learning to day trade, you'll likely want to explore resources for further learning. There are countless books and websites dedicated to trading education. When looking at online educators or courses, be cautious and do your due diligence. Seek out reputable sources that focus on education and risk management rather than just promising quick riches. Look for educators who clearly explain their strategies and emphasize responsible trading practices. While I won't recommend specific individuals here to avoid bias, exploring well-regarded books on trading fundamentals and technical analysis can be a great starting point. These tools and resources can significantly aid your journey as a beginner day trader. Start by getting comfortable with charting, understanding the impact of economic news, and most importantly, practicing with a demo account. The psychological side of day trading. Let's delve into a crucial aspect of trading that often gets overlooked, especially by beginners: the psychological side of day trading. The market isn't just about numbers and charts. It heavily involves your emotions, and understanding and managing these emotions is vital for success. Day trading can evoke a range of powerful emotions. One common one is the fear of missing out, or simply FOMO. This can happen when you see an asset's price rapidly increasing and you feel compelled to jump in even if it doesn't align with your trading plan. FOMO often leads to impulsive and poorly thought-out trades. Then there's greed. This can manifest as holding on to a winning trade for too long, hoping for even greater profits, only to see the gains evaporate. Greed can make you deviate from your take-profit targets and can be just as detrimental as fear. Conversely, the fear of losing can be paralyzing. It might cause you to exit winning trades too early to secure a small profit or hesitate to take necessary losses, hoping the market will turn around. This fear can prevent you from following your strategy and can lead to larger losses down the line. Another dangerous emotion is revenge trading. This often occurs after a losing trade. You might feel the urge to immediately jump back into the market to try and recoup your losses quickly. Revenge trading is usually driven by anger and frustration, and it often leads to further impulsive and poorly planned trades, digging a deeper hole. Given these emotional challenges, cultivating certain psychological traits is paramount. Discipline is key. This means sticking to your trading plan, following your rules for entry and exit, and managing your risk consistently, even when your emotions are telling you otherwise. Patience is also crucial. Not every moment is a trading opportunity. Being patient means waiting for the right setups that align with your strategy rather than forcing trades. It also involves having patience with your learning process. Becoming a consistently profitable trader takes time. Finally, the importance of sticking to a plan cannot be overstated. Before you enter any trade, you should have a clear plan outlining your entry point, your stop-loss level, and your take-profit target. When emotions arise during a trade, referring back to your predefined plan can help you make rational decisions rather than impulsive ones. Mastering the psychological side of trading is an ongoing process, but recognizing these common emotional pitfalls and consciously working on discipline, patience, and adherence to your plan will significantly improve your chances of navigating the markets more effectively. Common mistakes beginners make and how to avoid them. Let's go over some of the most common mistakes beginners make, and more importantly, how to avoid them. Over-leveraging. Using too much leverage amplifies both gains and losses. New traders often get tempted by the potential to make big profits quickly, but what they don't realize is how fast leveraged trades can wipe out their accounts. Solution: start small. Use minimal or no leverage at first until you fully understand how it affects your trades. Think defense, not just offense. Trading without a plan. Jumping into trades without a clear entry, exit, and stop-loss is like driving blind. If you're trading based on gut feeling or random tips, you're gambling, not trading. Solution: always trade with a plan. Know exactly why you're entering a trade, where you'll get out, and how much you're risking before you even click the buy or sell button. Ignoring risk management. Many beginners focus only on profits and forget to protect their capital. One bad trade with no stop-loss can set you back weeks or even months. Solution: use stop-loss and take profit levels consistently. Stick to the 1% risk rule. Protect your account so you can trade another day. Emotional trading. Reacting out of fear, greed, or frustration leads to impulsive decisions, like revenge trading or chasing moves you already missed. Solution: stay disciplined. Follow your strategy, take breaks when needed, and keep emotions in check by journaling your trades and reviewing them regularly. Revenge trading. This one catches a lot of people off guard. After taking a loss, many beginners try to immediately make the money back by jumping into random or oversized trades. It's an emotional response that almost always leads to even bigger losses. Solution: accept losses as part of the game. Step away after a losing trade if needed. The best traders know when not to trade just as well as when to enter. Now, paper trading first. Jumping straight into real money trading without practice is like stepping into a boxing ring without sparring. You'll get hit hard and fast. Solution: start with paper trading. It's a risk-free way to test your strategy, understand market mechanics, and build confidence before using real money. Avoiding these common mistakes early on can save you a lot of frustration and money. The goal isn't to be perfect, it's to be prepared. Before we wrap up, a quick but important disclaimer. I'm not a financial advisor, and this video is not intended as financial advice. Day trading carries significant risk and may not be suitable for everyone. Always do your own research and consult a licensed professional before making financial decisions. Now, with that said, let's recap. Day trading can be exciting, but it's also complex and fast-paced. We've covered the basics, different asset types, key terms like long versus short, bid and ask, the critical role of risk management, and the psychological challenges every trader faces. But here's the real takeaway. Successful day trading doesn't happen overnight. It requires real education, consistent practice, emotional discipline, and most importantly, time. Don't rush into live markets. Start with paper trading, build your strategy, learn from your mistakes, and grow at your own pace. If you found this guide helpful, drop a comment below and let me know which topics you'd like a deep dive on in future videos. Want to learn more about futures margins, option strategies, how to build your own trading plan? Let me know. I read every comment.
If you've made it this far, congratulations. You now know more about day trading than 90% of beginners who never take the time to truly learn. But let's be clear, this is just the foundation. Day trading isn't a shortcut to quick riches, it's a skill, a craft, and a mindset. And like any real skill, it takes practice, emotional discipline, and consistency to master. Now, if you found value in this guide, do me a favor, like the video. This tells the YouTube algorithm to share it with others who genuinely need it. It also shows appreciation for the hard work and hours it took to create this video. Subscribe to the channel so you're locked in for future deep dives, and hit the notification bell so you're the first to know when the next trading video drops. Finally, drop a comment below. What do you want me to cover next, or any helpful suggestions? Your comments and feedback are really appreciated. Thanks for watching, stay focused, trade smart, and I'll see you in the next one.